Hi, everyone. My name is Tamica Goode, and thank you, Tiffany, for giving me this opportunity. Today's class, I am going to be talking about business taxes and how it impacts the leadership and how it can make you a better leader if you understand your taxes. The outline for today, we're going to be talking about business taxes, of course, different business tax structures, the filing deadlines. I'm going to talk a little bit about the types of income and deductions and credits, how to avoid tax pitfalls, the importance of record keeping and documentation, and then go over a few tax planning strategies. So who am I? My name is Tamica Goode. I am a CPA. I have an accounting company where we do financial statement preparation, bookkeeping, tax advising, as well as tax preparation. I am also a fractional controller and fractional CFO. I have owned Tamica Goode LLC since 2017. Started out doing personal taxes only and then expanded into doing business taxes around 2000. And I'm a certified public accountant and have been so for over 25 years. So what are business taxes? So everyone knows that business taxes are required by the IRS. That's usually when you mention business taxes, that's the first thing people think of. But there are also other levels to business taxes. There are also state agencies that require tax filings, tax preparation, tax reporting. It's also a way for you for a business owner to report their income and expenses. But there are also banks and some financing agencies that also ask for business tax information when you are going in to get financing or when you're looking to scale your business. So just keep in mind, it's just not a way of reporting your income and expenses to the government. It is a way of managing and leading in your business. It is paramount that business owner understand their taxes. So it's not enough just to hand over your financial statements to a tax accounting at the end of the year, have them pull everything together and submit them to the IRS. You really should understand your taxes. You really should be able to look at your tax report and it should tell a story, and you should be able to tell that story. A lot of entrepreneurs, they really know their business, so they know how to make the sales, they know how to sell the products, but then they aren't always versed in understanding the financials and looking at those financials and understanding how those financials tell the story of their business. And then those financials translate into your tax documents. So if you understand your financials, you should understand your tax documents, and they work hand in hand. Your tax documents are also a way for business owners to be able to think strategically in their business. Of course, everyone wants to save money when they're filing taxes, but if you wait to the last minute, you may not always get the most deductions or, maximize your bottom line as you should. So you really have to think 12 months ahead, and sometimes even further than that when you're thinking from a tax perspective. There are legal and IRS granted ways to save money and to maximize your deductions, but if you don't think ahead, a lot of times you're not able to maximize on those. And then just be aware that filing taxes is a legal requirement. You cannot get around filing taxes and continue your business for a long time. And if you don't do them correctly, you could be in jeopardy of losing your business, paying fines. The fines could be so large you could eventually go into bankruptcy. And then if there are fraudulent things that you've done in your business and they're found out from a tax perspective, you could potentially risk some jail time. And we do not want that. So there are several different types of business taxes. And again, most people are definitely familiar with the federal income taxes and the ones that are due annually to the IRS. But also keep in mind that there are state agencies as well who require you to file income taxes. We live in the state of Virginia, and so Virginia definitely requires you to file state income taxes. There are some states that don't require that, but Virginia does, so definitely keep that in mind. And most state agencies, when you file, their due dates are in line with the federal due dates. Virginia, however, for your personal taxes, they push that out a little bit, and usually that's May 1st. But usually for business taxes, they are due when the federal taxes are done. If you are an employer, you may have employment taxes that are due. These can be due monthly or quarterly, depending on the nature of your business. Also, if you're an employer, when you file employment taxes, you're also responsible for what is called Social Security and Medicare taxes. If you're self-employed and you don't have any employees, so if you're a sole proprietorship or a single member LLC, you are also responsible for your self-employment taxes. So those are taxes that you have to pay on the profit that you make in your business. There's also the federal unemployment tax. You'll hear some people call this FUTA. You may not, have known what that stood for. There's also the component to that. It's called SUTA, which is the state unemployment taxes. So sometimes you'll hear people walking around saying FUTA and SUTA, but that's really what they're talking about. And then there's also sales tax. If you sell a product, you have to pay sales tax to the state agency that whatever state you live in. And then if you own assets in your business, you also have to pay annual property taxes on those assets. And they all have different due dates. So you definitely want to make sure that you're on top of those due dates. So there are several different business tax structures that cover a majority of business owners, especially business owners of Virginia. You can be a sole proprietorship, which just means you're the only member in your business, and you don't have to be incorporated. You can just be a sole proprietorship, and this would be filed with your personal tax return. And I'll get into that a little bit later. You can also create what is called a limited liability company. And you can be a single member limited liability company and still be considered a sole proprietor. And I'll get into that a little bit later too. But you can do that. Forming an LLC gives you a little bit more protection from your personal assets and your business assets. And that just gives you an extra layer of protection versus if you're just a sole proprietorship. The next level is a partnership tax return or partnership structure. That's when you have more than one, usually two or more members of a business, and you come together for a partnership. And then there is the corporation structure, which you can have an S corporation and a C corporation. An S corporation is a pass-through entity that can be formed either by one person, one entity, or up to 100 shareholders. And then a C corporation is going to be taxed as a single entity. And then usually the tax rate for a C corporation is going to be much more than an S corporation or an LLC. And usually you become a C corporation once your business is a little bit more robust, a little bit larger, usually more than 100 shareholders. And then you just get into a whole nother level of tax planning when you come to have a C corporation. Okay, so the first return that I want to discuss is the partnership return. And this is Form 1065. And you'll see that the partnership return and the S corporation return and the Schedule C, which is for a sole proprietorship or a single member LLC, they all have a lot of the same components, which goes back to you really need to understand the financial statements of your business, because all of these tax returns show basically two sections of your business. It has your income section, which shows all of your sales, your gross sales, your returns, your cost of goods sold. And then you have the section for deductions or expenses. And this can be taken directly off of your financial statements. So this is a good testament too, that you want to make sure that you're keeping really accurate records for your business. And the more detailed, the better. Because as you can see here, you have your gross receipts and your cost of goods sold. So you really want to have those broken out on your financial statement. If you have everything just rolling up to one line, you're going to have to take a lot of time to go back and break these out when you file your taxes or when you give them to your accountant. And a lot of times, if you want to have your tax accountant break that out, they're going to charge you a little bit more to do that because it's going to take additional time. So if you want to save yourself time and money on the back end, start doing that properly right up front. And then in your deduction section, you can see here, it is broken out in a lot of different deductions. So you want to make sure that you're mapping out your deductions really thoroughly on your financial statement so that when you're getting ready for tax time, it's not a lot of work to go through and break these out for your tax accountant. Next, we have the S Corp return. This is return 1120. Again, the S Corp is also a pass-through entity. And so what a pass-through entity is that you file a return for your business. However, when you file that return for your business, you don't pay taxes on that return when you file it. What happens is there's a schedule called a K-1 schedule that will be given out for each of the partner or each owner in the business. And then when that owner or that partner gets that K-1 schedule, they are going to file that on their personal return. So any percentage of the profit that owner receives from that business, they're going to pay taxes through their personal return on that percentage of the profit. So for example, if this S Corp had two shareholders, and each of those shareholders had 50% stake in the net profits, and if each of them received $100,000 in net profits, each owner is going to record $100,000 on their personal return, and then whatever their personal tax rate is, that is what they're going to end up having to pay on the bottom line when they file that on their personal return. And this is a little bit different from a C corporation, because when you file the tax return for the C corporation, you will have to pay the taxes on your net profit at the time of filing that return for the C corporation. So that's a little bit different. And that is definitely something you want to take into consideration when you're determining the structure of your business. If you want to be an S corporation, you know, at the time of filing, you won't pay taxes then, but you will have to pay taxes on your personal return. And so then you really have to be in tune with what is your personal tax rate, you know, what other deductions or offsets would you possibly have on your personal return to offset any of that income. And on the converse side of that, if the business has a loss, you also get to take a percentage of that loss to your personal return to offset any personal income and any personal income taxes that you would have to pay on that personal return. One thing to really notice here, again, that is broken out into the income section and deductions. You cannot get away from knowing how to show your income and your expenses. So again, you have to be in tune with your financial statements. You have to get permission from the IRS to be able to have a C corporation. And so you should file a form 2553 once you decide to become an S corporation. I'm sorry, I might have said C earlier. When you decide to become an S corporation, you have to file that form with the IRS and get approval to be an S corp. And then once you have that approval, you're able to file. Now, if you get towards the end of the year and you haven't filed this form with the IRS and haven't gotten approval, when you file your tax return, you know, in 2024, say you started to become an S Corp in 2023, when you file your S Corp in 2024, there's a section here on G that says, are you electing to be an S Corp? And if you are and you haven't filed that document with the IRS previously, you can select yes here and then attach 2553 to your tax return when you file it. And then a lot of times the IRS will see that and say, okay, we approve, and then they'll let you file as an S Corp. If they reject it, they'll send you a letter, send you a notification, and then you can work with them on how to resolve that going forward. But I just wanted to make everyone aware of that is something that you can do. This schedule is a Schedule C form, and this form is for all sole proprietors and single member LLCs who want to file their taxes. And this schedule is not a standalone schedule. This schedule is actually filed with your personal return. So if you file a 1040, this Schedule C will be pulled into your personal return as one of the forms that will pull into your 1040 form. And you can see here, again, you can't get away from having income and your expenses broken out. Again, it all ends back to you have to know your financial statements and you have to be accurately recording your income and recording your expenses. One good thing about the Schedule C form that you don't see on the other forms as a section that calculates automatically. If you have a home office, the Schedule C form will calculate a deduction that you can get for having a home office. In previous years, it used to be a little bit more complicated. You really had to do a lot of calculations on the back end, but they really simplified it. And now they ask for the total square footage of your home and the total square footage of your office. And then it gives you a percentage, and then it gives it performs a calculation that says, this is how much you can deduct for your home office this year. Do you accept? If you do, you select yes, and it will put an expense on your Schedule C form for that. With an S corporation, you can still deduct the expenses related to your home office. It's just going to have to be done manually and outside of the tax return, and then your accountant can bring it into your tax return. But there is a way to do that, and a lot of S Corp owners don't realize that. So if your accountant hasn't brought that up or talked to you about that, you may want to ask about that, because that is a way that you can save additional money and have additional deductions on your tax return. One thing about the Schedule C form, you really have to understand your expenses. And the reason why I say this is because you are able to take some depreciation, and if you have a car or a vehicle that you use in your business, you are able to take either the miles that you've driven. So if you drove like 100 miles, the IRS may give you, I can't remember the rate off the top of my head right now, but they may give you like 61 cents per mile that you've driven. So you really want to keep up with the mileage that you are driving in your business, or you can use the actual expenses that you have incurred for your vehicle, whether those are gas receipts, repairs, if you needed new tires, needed oil change, you can use one or the other. So talk with your accountant on what's best for your business. For all of the entities, there's something called depreciation, and that is where you buy an asset and you have the option to expense as much of it as you can under the 179 election in the current year, or spread it out over the life of the asset. Again, that's where you really want to partner with your accountant, because sometimes people think, oh, just give me all of the expenses this year. I want as many expenses as I can get. Well, that may not be as beneficial for you, because if it takes your tax obligation to zero, and then you deduct another $10,000 in expenses, is that really helping you out that year? That may not be the case. You may want to save that expense for the next year or the next 5 years to offset future income, so that you can pay less taxes over time, and not use all of that deduction in the current year when it may not be beneficial. So again, just make sure you talk to your tax accountant about that, and make sure that you're making the smartest decisions. And this also lends back to, you really have to know your business. You really have to know your tax statements, because you want to make the smartest decisions for your business. You don't want to just put that over in the hands of someone else and let them make the decision, and not realize that it could be helping you in future years to save some of those deductions versus getting them all in the current year. So federal tax filing deadlines. A lot of individuals are not aware that if they have an S corporation or a partnership or a regular a C corporation, their tax deadline is earlier than the normal April 15th that everyone is aware of. If you're an S corporation or partnership, your deadline is going to be March 15th. And I have worked with a lot of clients where, they'll contact me like, March 15th and say, I'm ready to give you all of my stuff to file my taxes. And I'm like, well, we can't file it today because the deadline is today. So we really have to scramble to get an extension submitted. And that's if they give it to me ahead of time. If they don't, then you're at the risk of being late. So make sure you touch base with your accountant and get them all of the information they need in time to file your taxes by the deadline. And if not, definitely file an extension. And this is important, not just so that you won't be late, but if you're an S corporation and you don't meet that March 15th deadline, and you don't file an extension by March 15th, you could be penalized. I think the rate this year is $230 a month for each month, and this is per partner. So if the S corporation has 10 shareholders, each shareholder is going to get charged $230 a month for each month that tax return is late, if you don't file an extension and if you don't file your return on time. So that's very important. And the filing an extension is really easy. You can have your accountant just do it electronically and just send it, or you can print a document out, fill out the form, and just drop it in the mail, and just make sure it's postmarked by that date, and then you're done. Most state tax filing deadlines coincide with that federal deadline. There are a few states that will give you a few extra weeks after the filing deadline, but my thing is, if you get that federal done, usually that state is done in conjunction while you're doing that federal. Just go ahead and get it in so you don't have to worry about it. So I went over this kind of quickly when I was walking through the statements, but I wanted to circle back around to income. What is considered income? So any service or any product in your business is considered income, and you should record that as income. I also have learned that a lot of times people will receive grants, and I would probably say 98% of the time grants are not taxable, but there are some grants, and I have seen some grants where when you get the paperwork, in the paperwork, it does say this grant is taxable. So you really want to make sure that just because you receive funds and it says grant, it doesn't always mean that it's tax-free. So you want to make sure that you are filing those correctly. And if they aren't taxable, you don't file them. But if they are, you want to make sure that it's included. Another question that I get a lot of times from business owner is, what is considered cost of goods sold? Now, a lot of times if you're selling a product, it's really simple to understand what is cost of goods sold. It's anything that's used in the manufacturing or getting a product ready to sell. But for service business owners, sometimes it's a little bit gray as to what that could be. And I always say is whatever positions in your company or whatever part of your salary that you do to actually render a service, then that should be considered cost of goods sold. So if you have a salesperson and all they do is sell and all they do is get you the clients and get you that sale, their salary should be cost of goods sold. If you're the business owner and 50% of what you do is to render the service and 50% of what you do is managing the office, then 50% of your salary should be cost of goods sold, 50% should go to operations. So just keep that in mind. And then how is it calculated for tax purposes? Again, partnerships and S Corps are considered pass-through. When you file your taxes, they aren't taxed at that time. They are passed through to the owners and to the partners and filed with their tax returns. Corporations, when they are filed, C corporations, they are taxed at the time of filing. Sole proprietorships and limited liability companies, if they're a single member, they are filed on the personal tax return as part of Schedule C. Another thing I want to point out, if you're an S corporation, you can pay yourself as an owner. And when you do, you will receive a W-2 from the S corporation, and you will file that on your personal taxes as a W-2 income. If you're a sole proprietorship or a single member LLC, you cannot pay yourself a traditional paycheck. You can take owner withdrawals from the company, and when you do, these are not considered an expense. It's not considered a deduction. So what happens, and give you an example, say your business makes $100,000 net profit, but you decide that you want to take owner withdrawals of $100,000. Even though you took that cash and you put it in your pocket, your business still made a net profit of $100,000 and you still have to pay taxes on $100,000 if you're a sole proprietorship or a single member LLC that's seen as a sole proprietorship in IRS eyes. And a lot of business owners get confused about this because they think, oh, I'm taking the money out, I'm paying myself, this should be an expense deduction. So at the end of the day, my net income should be zero. That is not the case with the sole proprietorship. So keep that in mind. Your net income falls to the bottom line, and no matter how much money you take out, you still pay taxes on the net income. With an S Corp, when you pay yourself and you get a W-2, you can deduct that W-2 expense or that payroll expense from the net profit. So the net profit of your S Corp will be smaller, but you still have to pay your personal taxes on the income in that W-2. The key there is that you're not having to pay the self-employment tax on the income that you make in that S Corp. So you do save a little bit of money, a few thousand usually when you have an S Corp and you pay yourself, but you want to partner with your accountant to make sure that you want to be an S Corp and not a sole proprietorship or an LLC, because there are advantages and disadvantages to becoming an S Corp. And you want to make sure, you want to weigh them out to make sure that your business is ready to be at that level to be an S Corp. Usually you have to have a certain amount of income, or you want to have a certain amount of income. And then you have to make sure that you're not taking an exorbitant salary, because the IRS is all over. Are you taking a salary that is customary of the position that you're filling in your business? So I just wanted to make sure I put that out there and made that clear, because I do get a lot of questions about that and it can be a little bit confusing. So tax deductions and credits, we've gone over a lot of business expenses and deductions for all the business side of the tax returns. But then if you're if you're a sole proprietorship or a single member LLC, as well as when you get the K-1 from the partnerships and S Corps, you also have the benefit, because you're filing all of those on your personal taxes, you have the benefit of the standard deduction and the itemized deductions. And these are the deductions that the IRS gives individuals pretty much just for, filing your taxes and, living in America. The standard deduction is the same for everyone if you don't itemize. There's a married filing separately, there's a married filing jointly, and then there's a head of household. But then you can have itemized deductions. So if you have other deductions like, you gave to charity, you have high medical expenses, you have high real estate, property taxes, that brings it, when added together, is higher than the standard deduction, then that will further reduce what you have to pay in taxes on your income. There are also things called refundable credits and non-refundable credits. So a refundable credit is a credit that the IRS provides to taxpayers that you can get money back. And a lot of times this is going to be like your earned income credit or some of your child tax credit. That means that when your tax liability gets to zero and you don't owe any more taxes, if you still get this credit, you'll get money back above and beyond what you owe in taxes. A non-refundable credit is a credit that the IRS gives you that only reduces the taxes that you paid down to zero. Once your tax gets to zero, and there is still more credit available in that non-refundable credit, you won't get additional cash back. It'll just say, oh, we got your tax down to zero, we're done. You don't get any more money. So I just want to make people aware of that. Again, common business deductions this is where, again, it's very important to know your financial statements to make sure that you are getting all of your deductions. Again, the most important thing I think for a sole proprietor is knowing the depreciation expenses that you can get and your car and truck expenses, as well as the simplified home office method. And I think a lot of times some business owners may not get these deductions because most of the time you don't record depreciation expense in your financial statements. This is one of the expenses that a lot of business owners may not understand fully, so they don't know how to book that on their financial statements. And they may wait for tax time for their tax accounting to do it or the year-end bookkeeping cleanup. So just make sure that you ask those questions and make sure that that's not something that's been glossed over and you lose that deduction. So common mistakes to avoid. The main one that I talked about earlier was not filing on time and not filing your extension on time if you're not going to make that deadline. You want to stay on top of those deadlines. You want to be in communication with your accountant to make sure that you're in line with those deadlines. Not keeping accurate books. That is a big no-no. One, you could miss out on deductions. Even worse, you can miss out on reporting income, and then someone else reports income that they paid you to the IRS, and then the IRS is like, oh, they're not reporting their income, are they? Let's just audit them a little bit and see what else they didn't provide. And so you don't want to open yourself up for an audit and then be on the IRS's radar. Commingling your personal and business income and expenses. You want to make sure you keep those separately, because if you do get audited and an auditor comes in and you have a business expense in your personal account and you don't really have good receipts or good support for that, they're going to say, well, it's in your personal account. You don't have good receipts. We're going to say that should have been a personal expense, and then they're going to remove that from your tax return. And you really don't want to do that. And then you want to make sure that you don't do anything fraudulent. Paying taxes is a part of life. You're going to have to pay tax if you're profitable, if you're making money. So save for that. Put money aside for taxes. Pay estimated taxes if you're making income each quarter. Pay estimated taxes on time. And understanding your finances and understanding where you are from a tax perspective helps with that, because you don't want to pay too much money in estimated taxes when you could have put that money in an account and made money yourself off of your own money. And you don't want to pay too little, because then you don't want to be faced with penalties for not paying on time. And then just making sure that, you're staying aware of what's going on in your company, so that, especially if you have employees, because if they do something fraudulently, it could come back on your business and then impact you. Again, the importance of keeping accurate records. Don't commingle, record everything. If you have a system like QuickBooks, or I know there's one that Tiffany really likes, and I can't remember the name of that one right now, have some type of software. If you can't afford that, you could definitely use Excel, but just make sure you keep accurate receipts and records. Yes, Tiffany?
Wave is free.
There you go. Was it WAVE? W-A-V-E? Okay, I can never remember that. So yeah, some type of record keeping is really important. It just makes life so much easier, especially when you have to hand everything over to your tax accountant. And again, if they have to go through a lot of receipts, a lot of Excel documents, it's going to cost you a lot more to get your taxes done. I love when a client just gives me reports. I ask a few questions. If I need to know a receipt or have support for something, I ask, but if everything's in the right buckets, it just makes it so much easier, makes their life easier, makes my life easier, and it also saves them money. You have to know your financial statements. The main two that you're going to use for taxes are going to be your income statement and balance sheet. Cash flow is usually not really needed for taxes, but you do want to understand your cash flow when you're thinking about, are you going to be able to meet your future obligations? in your business, you have enough cash, but definitely your income statement and your balance sheet. Why is the balance sheet important? Because that's going to have your assets on it, and then that's going to determine, your assets are going to determine what can be depreciated, what can't be depreciated, and how long things should be depreciated, which is another deduction for your business. I get a lot of questions regarding, should I have digital or physical documentation? And I would say whatever works best for you. If you hate digital and it just is really confusing and you really can't get it organized, don't do it. But if you decide to do physical, make sure it's organized, easy to read, and easily hand it over, where you can hand it over to your tax accountant. But whichever one you use, you want to make sure that it's accurate and organized. The best tax planning strategies is yes.
3 minutes, just 3 minutes before Q&A. Just wanted to give you a heads up.
Okay, thank you. I think I only have 2 more slides. You want tax planning is a year-round thing. You don't want to wait until November, December to decide to talk to your accountant about how I can save money, because then it's usually too late, or you may make decisions forced that you may not be, really want to do a year in. Maximize your deductions when you can, but however, think forward. If you eventually want to ask for a loan, a business loan, or you want to show a net profit, sometimes you may want to stretch out that depreciation over 10 years versus having it all in this year, if you know that you're going to have to go to a bank and ask for lending. Pay your estimated taxes. You don't want to get to the end of the year and owe $30,000 and are shocked because you weren't tracking your income during the year and not paying estimated taxes. Recap: know your financial statements. Knowing your financial statements help you know your taxes. Being in line with your taxes and being in tune with your financial statements helps you be a leader and helps you think strategically. Always be compliant. Not being compliant is the easiest way to shut your business down and to not, have a going concern. And continuously learn about what's going on in taxes. If you're not a tax guru, partner with someone that is, so that you're aware and can be ahead of any tax changes that may impact your business. Was that 3 minutes, Tiffany? Any questions? I would be happy to answer any of them that I can now.
Perfect. I'm going to end Facebook Live right now. I want to thank everybody who participated on Facebook Live today. If you're not a member of Empower People, I encourage you to do so. It's free, and then that way you can take advantage of the Q&A session that follows immediately after the course. Take care, everybody.
Bye-bye.